Gold made a high in April, above 2,400. Gold made a high in May, above 2,400. Gold's high this month, just above 2,400. So you had 3 months in a row up there with highs within 1% or so of each other. Hardly a dynamic top, you know what I mean? A spike top. Like in summer 2020, when you hit your high, you dropped. 2011, when you hit your high, you dropped. You didn't come back to it again. Okay. So we're getting really a lateral movement in gold. Right now, as we do the interview goals like 2310. Okay. So it's 3-4% off. It's the 2,400 level. It's just a sideways, boring looking thing. So we think we're close to the end of the congestive pullback, and we'll resume the acceleration phase. What is likely to help spark that resumption? Watch the stock market.
In the ever-evolving landscape of precious metals, gold and silver continue to capture the attention of investors and analysts alike. On April 20th, gold reached a record high of $2,450 an ounce, showcasing its enduring appeal as a safe haven asset. In contrast, silver remains far from its all-time high of $49.78 set in April 2011, a disparity that has sparked renewed interest in the white metal's potential hidden value. MichaelOliver, the renowned founder of Momentum Structural Analysis, MSA, offers a compelling perspective on the current market dynamics. Oliver, known for his unique approach to technical analysis, believes that gold and silver are nearing the end of their recent pullback, with silver poised for a potential resurgence. His analysis suggests that even a modest upturn in silver prices could trigger a significant upward movement. Historically, silver has been characterized by wider and more aggressive price swings compared to gold, although recent market behavior has deviated from this pattern. This divergence has caught the attention of retail investors, who are increasingly focusing on silver's unrealized potential. As of Monday's early Asian trading hours, gold prices have edged lower to $2,325, influenced by the Federal Reserve's ongoing cautious stance. Market participants are closely monitoring upcoming economic indicators. Oliver's analysis paints a bullish picture for both gold and silver. He anticipates the current consolidation phase to give way to an acceleration phase, drawing parallels to previous bull markets where gold saw 8 to 10-fold increases over a decade. While Oliver refrains from making explicit price predictions, he hints at the potential for substantial gains, particularly in the final year of the bull trend. Join us as we delve into MichaelOliver's insights. To stay updated with our latest uploads, subscribe to our channel and activate notifications. Thank you.
First off, in our assessment, the gold bull, we're flexible on gold long-term. We primarily look at long-term trends, sometimes intermediate. But we got bearish on gold, for example, in 2012. So, we're fair and balanced, okay? After it peaked at 11, 3 months later, we said, that's it. It never could get back to its high again. It just labored in 2012 and finally crashed in 13. Then in, in February of 2016, coming up off of its low at 1,050, actually 1,046, at $1,140 in February of 2016, annual momentum said, green light again. Bull trend has begun. Okay, nothing on annual momentum has argued since then that trend is over. It's been ongoing. Despite the 3.5 years that gold spent capped off at just above 2,000, and silver in downward staircase and miners in a downward corrective staircase for 3.5 years. That pause did not break the dynamic of the annual momentum positive trend for gold. It just paused it. Okay. The action in March in gold coming up through the price highs, actually. The price was fairly coincidental then. Annual momentum of gold broke out through a secondary structure, saying, okay, end of prior bull markets. There's been a couple in the last 50 years where gold's gone up 8, 10-fold in a matter of 10 years. Mid-1970s to 1980, 2000 to 2011. Okay. Well, if we went up the same dimensions that we went up back then, gold would be $8,000, $9,000, an 8-fold move. I mean, those moves are 8 and 10-fold moves. Okay. But usually most of that move occurs in the last year of the bull trend. Most of the dynamics occurs then, where it suddenly unleashes. And right now we argue you've got the fundamental and technical background that gold has never had before, the dynamics of which should drive it, should explain why that kind of dynamics will unfold. Gold made a high in April, above 2,400. Gold made a high in May, above 2,400. Gold's high this month, just above 2,400. So you had 3 months in a row up there with highs within 1% or so of each other. hardly a dynamic top. You know what I mean? A spike top. Like in summer 2020, when you hit your high, you dropped. 2011, when you hit your high, you dropped. You didn't come back to it again. Okay. So we're getting really a lateral movement in gold. Right now, as we do the interview goals like 2310. Okay. So it's 3-4% off. It's the 2400 level. It's just a sideways, boring looking thing. Silver, meanwhile, did something different. Now, right now, it looks like silver's had a deeper pullback than gold. Yeah, over the last 4 or 5 weeks, it has since the May high. But silver in May vastly took out its April high, unlike gold, which plateaued. Okay, silver went on further. We suspect, based on shorter-term momentum trend dynamics, that this pullback you're getting right now in silver, and as we're speaking, it's down under 29. Okay, it was under 29 a week or so ago as well. We think you're probably very near the low, if not at the low, and it won't take like a $1 upturn from current price levels to really explode it up out of the hole again. You don't have to go back to 32.5 to make the point. You get up around the upper 29s next week, you're going to resurge. It's going to resurge again. So we've got some charts that show that point there. But when you look at like the daily action of gold since let's say April or May, you see this sort of sideways on momentum. You see a very clear multi-point downtrend structure, something that if you break out above is a buy signal. You can't find that line on the price charts. Price charts are sloppy. So the price charts leave you confused. So we think we're close to the end of the congestive pullback, and we'll resume the acceleration phase. What is likely to help spark that resumption? Watch the stock market.
Oliver, known for his unique approach to technical analysis, anticipates signs of the stock market bubble bursting as early as the third quarter of this year. His prediction is specific, focusing on the next 3 months rather than the traditionally volatile fourth quarter. Complementing Oliver's forecast, a Harvard Business School alumnus has warned for years of a significant crash and subsequent economic depression. He characterizes the current market as the bubble of all bubbles, attributing this precarious situation to a decade of loose monetary and fiscal policies that artificially inflate asset prices. Harry Dent's projections are particularly stark. He estimates that the S&P 500 could lose up to 86% of its value when the bubble bursts, while the Nasdaq Composite might plummet by as much as 92%. Even more alarmingly, he suggests that high-flying hero stocks like Nvidia could see declines of up to 98%, implying a multi-trillion-dollar market crash. Oliver's analysis extends beyond the crash to the potential response from central banks. He predicts that when the stock market bubble bursts, the Federal Reserve will panic and revert to its conventional policy of lowering interest rates. This reaction, Oliver argues, is driven by the Fed's mandate to address unemployment, which often rises in the wake of significant market downturns. Let's get back to the interview.
First off, I've said this before in some interviews, and I'll say it again. In fact, the Mises Institute, which I've affiliated with somewhat, had a one-pager in the Wall Street Journal a couple of days ago about who needs the Fed. It was like a huge article. It was an intellectual article attacking the notion of a centralized government-run central bank. Anyway, I think in 5 years you won't have a Fed. And the Fed is almost always behind the ball. They create situations with their monetary boom-bust policies, which create quite often stock market boom-bust attributes.
Yeah.
And the last one, where they went berserk on QEs for years, created the biggest bull market, quote unquote, in stock market history in the US. We went up from about 8-fold advance in the S&P 500 over a span of 12, 13, 14 years, and about a 17-fold increase in the NASDAQ 100. Now, you go back and look at the 1929 bull, or look at the mid-70s bull, or look at the dot-com bull peak, or the real estate peak in 2007. No stock market bull trend matched the duration and the percentage gain. And if you look at money supply growth over the last decade or so compared to prior, it's more. You look at Fed funds rate, effectively zero, except for 2 years of the last dozen, okay. You understand why. Hey, no wonder there's a stock market bubble. They blew air into it. Well, the problem is when the bubbles break, and they always break, the Fed panics. The Fed has to go back the other way, okay, because that's one of their priorities. Remember, unemployment is one of their other mandates. And so as soon as you see the stock market start to break, that's going to yank the Fed back into their normal policy mode because they'll have to panic. The other major central banks like ECB and BOJ, they were already inclined that way. I think ECB's already cut rates. So the whole group will shift back to that again once they get a little prick from the stock market. And I think they're going to get a prick. And I think the bubble's going to exhibit busting behavior, especially in Q3 of this year, I mean, in the next 3 months. Not Q4, the October notion of the October crashes in 87 and 29. No, I think if you're going to get some sharp, sudden surprise down, which I don't think will be a surprise to us, but to a lot of folks it will be, you're going to get it in the next 3 months. And we measure the technical factors that might spark that event. And I think they're there. They're very ripe. And it won't take much of a sneeze starting next week, next quarter, to start to generate that breakage.
Given the divergent performance between gold and silver, ongoing economic uncertainties, and potential stock market volatility, how might precious metals fit into a well-balanced investment strategy for the remainder of 2024 and beyond? Share your perspective in the comment section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.